Welcome back to episode 10, I believe this is, of Talking Stocks. I'm Joe, and with me, as always, is Todd Campbell. Todd, how are you?
10.
I know we made it. Big
Double
milestone.
digits, Joe. What a fun ride it's been so far. I mean,
Mm-hmm.
this experiment that we're doing, hopefully our listeners and our viewers on YouTube are enjoying it. And maybe they could leave a comment underneath, let us know if they want us to continue with these weekly missives. And hopefully they're finding it useful. And if they have any questions, obviously, they can always reach out to us in the comments or on Twitter. You can follow
Absolutely.
me at EB Capital, or you can follow the regular Limelight Alpha at Limelight Alpha on Twitter.
That's right. All right. So we got some more encouraging news this week about COVID vaccines. And, it sort of seems like there might be some light at the end of the tunnel for this with this very positive news from Moderna and their phase 3 clinical trial. And then also Pfizer, which we talked about last week. They released kind of a schedule of when people will be able to get their vaccine. And I have to say, I was a little bit surprised that some people might be getting this thing next month. So let's kind of dive into that. I'm curious to hear what you have to say about like what specific stocks and what general industries are going to be affected by this.
Well, a couple of just general observations. We saw, Pfizer come out and they had that 95. Well, at first they said, it's about 90% effective. They've since revised that up to about 95% effective. That puts them in line with Moderna, which had come out and said 94.5% effective. And I think today Pfizer announced that they plan, or they are actually filing for emergency use authorization from the Food and Drug Administration. I think everybody expects that will be granted. And then the big question then becomes, okay, how exactly does the vaccine end up in people's arms?
Right.
How are they going to distribute it? And, is there enough, is that plan, flushed out enough where it all goes smoothly and it goes to the right places? And I think that's still in the kind of remains to be seen category. But, heck, we did this with polio back in the 1940s or 50s. So, there's evidence that we can do this. So I feel pretty optimistic that it's going to happen. It's a matter of time. We have seen this week a huge, I shouldn't say huge, we've seen a spike, an increasing trend, right? I mean, everybody had been talking about the fact that we could see a resurgence in the fall as colder weather, as weather gets colder, and that's what we're seeing. We're now at record number of daily cases. We're at record amount of hospitalization, and I think that obviously that's concerning. And as a result, you're seeing some action in some of these work from home plays. We're trading higher again today. We talked about Chewy last week. I think Chewy is one that will do well. It was doing well ahead of COVID. It's doing even better because of COVID, and now I think it'll continue to do very well regardless of the vaccine. I do caution though, Joe, because some of the, our research has been tilting away from technology for weeks, dare I say almost 2 months. I think that last week in the report, it was low neutral in large cap and neutral in the other two market caps, mid and small. And I think that this week it may actually have a little red tint to it in the large cap. Semiconductors doing incredibly well. But again, some of these baskets that you would think might be doing well, like technology, work from home plays, maybe don't chase those on this news. Maybe stay focused on, some of these other baskets that are ranking better for us. That said, you're seeing some big money flow into some of these healthcare stocks, including the vaccine stock Pfizer. I don't know if you saw it, Joe, but Berkshire Hathaway, Warren Buffett's firm,
Oh, yes.
stepped up and took some stakes in some healthcare companies last quarter.
That's right. Yeah. So I believe the two that are high scoring in our research this week are Pfizer itself and AbbVie, if I'm not mistaken.
Yeah, Buffett bet on 4. He bet on ABBV, as you mentioned, that's high scoring in our work. And I think that's one that investors should look at, especially it's very close to a key breakout technically. Again, I use technicals just to help me time my entries. Once you've done your fundamental homework and you feel good about the company and you're willing to take on the generic risk to its best-selling drug, Humira, is a whole nother show in itself. But if you feel good about that, then you're coming up close to an actionable entry point for that stock. So AbbVie is one to keep in mind because you mentioned it's high scoring in our work. Pfizer also is high scoring in our work, and actually that's just about back down to its 200-day moving average. So I think that investors can also consider joining Buffett in adding that one to their portfolio. The other two, Merck and Bristol Myers, I just put in the wait and see camp. Wait until those scores start to improve in our research. But I think AbbVie and Pfizer, both for different reasons, score well in our work and can be added, and you can follow it along in Mr. Buffett's footsteps on those two.
Absolutely, yeah. So I'm curious. This is just kind of off the cuff, but I'm curious to hear what you think, like the kind of near future is, next few months for a stock like Zoom, because if we if we all have a vaccine in our arms by April, there's a lot of uncertainty as to what's going to happen with Zoom in the future. I mean, are we seeing the sunset on the golden days of Zoom?
Well, I think that most investors fall into one of three buckets: very short term, mid term, and then long term. And I think that you can make an argument that short term and long term, Zoom is a stock to have in your portfolio, right? Midterm is where it starts to get wonky.
Right.
How much have we pulled forward on sales for that company? You're going to get revenue deceleration. You can't grow at, mid triple digit percentages
Right.
for very long without that kind of a catalyst. I mean, obviously video conferencing is an area that I think is here to stay. It's not like people are never going to Zoom again. So I think that they're going to do fine. So that's why I say long term, just ride it out, right?
Yeah.
If you're a short term, say day trader, or maybe you're a position trader, yeah, buy it on the down days, sell it on the up days, right?
Yep.
Why not, right? I mean, there's still enough action in that stock where you can make some money doing it. What's interesting to me, Joe, is that if you think about the video conferencing, kind of those work from home plays, they really, they were great scoring in our research up until, I don't know, September, something like that. And then they kind of rolled off and semiconductors took the lead. I would much rather be buying semiconductors than I would some of those work from home software as a service type stocks. There's only a few that still score really well for us. So I think that if you're a medium term investor, you kind of fade the rally, reduce your exposure to the stock, book some of your profit and redeploy it in some of these other ideas. I will also just add, though, Joe, is looking through the research earlier today, and one company that does have its toes in the video conferencing business that screens higher than Zoom and others, and that maybe has more staying power in that medium-term outlook too, would be Ring Central. So I think that RNG is the symbol there, Reagan, Nancy, George.
Yep.
I think that would be an alternative maybe. They do business, they're enterprise oriented. Most likely they're going to stay, they've got longer term contracts with their clients. Obviously they're not a high flyer like Zoom. They're more of a diversified enterprise communications company. But that would be an interesting stock to start thinking about adding to your portfolio in that basket. So I guess the long answer to your question, Joe, would be, if you're short term, trade around the edges. If you're long term, sit and let it run. If you've got some if you're medium term investor, maybe rein in some of your exposure to it, keep it on, but free up that cash to use on other opportunities.
Absolutely. Yeah. And there are plenty of better options out there for the medium term investor. And we have plenty of those highlighted in our reports every week. So with that, let's shift gears a little bit and let's talk about Tesla, because Tesla got some very exciting news this week, and they are now part of the S&P 500. So I'm curious, like how this is how this is going to affect them going forward.
A lot of people thought that Tesla was going to get added to the S&P 500 in the September quarterly rebounds. It didn't happen. I think people were surprised by that. Shares sold off on that disappointment.
Yep.
They did indeed announce, as you just said, that they are being added to the S&P 500. The official date for inclusion is going to be December 21st. They are polling institutional buy-side firms to kind of find out how best they should try to add Tesla to the index. And what's interesting about Tesla joining the S&P 500, Joe, it's kind of unprecedented for a company this big to not already be in the index.
Right.
You know, I mean, this is a massive company. It's going to be one of the top 10 or 12 by size in the index once it's in there.
Yep.
So, I mean, you only have, I mean, you've got 500 stocks in there right now, right? Normally you pull one stock out, you add one stock in. But what are you going to do? You'd have to eliminate 3 of the companies at the bottom to be able to come up with enough cash to be able to put it into, to get Tesla to the weight you want. You know, it's going to be very interesting to see how, do we see some sell pressure across the entire 499 other stocks just in order to be able to get, you know, Tesla in at that amount? And, you know, Joe, I was looking earlier today, there are $11 trillion that one way or another track the S&P 500. 11 trillion. So, you know, Tesla wasn't in any of those. So now it's got to be in all those, and it's got to be in at a relatively, you know, high weight. So it's not shocking that Tesla shares are running higher on this news of inclusion, and probably will see tailwinds over the course of the next, you know, 2.5 weeks or whatever, until we get up into that the official 12/21 date for addition.
Yeah. So here's a question for you going off of that. So like most of the companies in the S&P 500, they're profitable. They're, for the most part, pretty well established. A lot of them you would consider mature, and they're not particularly volatile. Now, obviously, Tesla very much is volatile still, and you could argue that they're not a very mature company either. So I think like my concern is, like, as somebody who, you know, owns a bit of an S&P 500 index fund, how is their size and their volatility going to impact the index as a whole?
I think once it gets up to okay, short term, long term, medium term, long term again. You know, long term, I don't think it'll be too much of a headwind or a tailwind. You know, it's going to be a top 10, but that means there's not 9 other ones in the top 10 that, you know, can offset it with moves. I do have some concerns that you could get there are a lot of people who are buying Tesla simply because it's being added to the S&P 500. You and I, Joe, would go back to, you know, the class you took with me, how to talk stocks, and say that's not a good reason to be buying a stock and owning it, right? But I understand why people are doing it. What typically ends up happening, it's kind of like last week's show when we were talking about, maybe we can put a link in box for last week's show, but you know, kind of where we were talking about don't game EPS. It's kind of the same thing. Don't game inclusion into the S&P, because what can happen is that a lot of people are buying because of that. And if you're not one of the first people to exit, then you could get caught with a downdraft. It wouldn't be shocking to me if after a 500%, I think it's 500%, yeah, 500% move higher in Tesla this year, that once the big catalyst of being added to the S&P 500 is beyond us, that the stock kind of starts to lag. So, you know, it's one of my largest positions personally. It's grown into it. I start off most of my investments at a starter position, and then I just let them grow. It has now grown to become an outsized position in my portfolio. So for risk management purposes, the way I'll be approaching my holding in Tesla is to trim it ahead of the actual inclusion date. So, you know, where some people may be buying it a few days ahead, I would caution against that, just because we could see people exit after the inclusion date. That said, hey, I'm a long-term believer in what Musk is trying to do. I do believe that electric vehicles are the wave of the future. I do believe that solar is the power for the future. So, it's going to remain in my long-term portfolio. I'm just not as comfortable after this big move and after this big catalyst of having it be my top three uh, stocks in my portfolio.
Yeah,
I want to rein that back a little bit.
definitely. Yeah. So one question that I have based off of what you just said, for those who don't know, can you kind of explain like what a starter position is for you, what that looks like, and then as you like kind of as a percentage of your overall, and then as you expand that, like what you kind of look to target as like an upper end for your stronger picks.
Yeah, I'm weird.
Hey, at least you
Yeah,
admit it.
yeah. I'll lean right into it. I am abnormal, and people are going to be absolutely flabbergasted by this next stat that I throw out. I own over 95 stocks. That's kind of crazy. Most people won't do that. Now, of those, more are winners than they are losers. I sell stocks if my catalyst for buying them breaks. If they don't, I just sit on those positions and then let nature take its course to make them smaller and smaller as the winners win. As a result, I would say that my normal size position is typically about 3%. Some that have like some of the energy stocks maybe that are in my portfolio, I still have two because the catalysts haven't busted on it overall for offshore. I think that those are probably down like 0.10 weightings in the portfolio. So normal weighting for me, I would say is about 3%. So you're talking about a 30 stock, 33 stock portfolio, something like that. Usually if we're in a period like March, I will go in much more aggressive in buying that 3%. I will either take it all in one lump sum or I'll take it in two chunks. Whereas in a period where if I feel like the stock is kind of extended, the timing doesn't look right, technically it doesn't really look like the best entry, but I really do like the stock, then maybe I'll take a starter position at about 1%. And then I'll look to either add it if it's working or if my catalyst isn't busted. I'll add to it in relatively short order if it's down for a couple days. I don't, as a rule, add to losers. So like if one of those stocks I put on, the catalyst doesn't break, so I still own the stock, but it's fallen over a 6-month or 12-month period, I'm not going to buy it just for the sake of buying it to dollar cost average down. No. But in the first week or two of putting it on, yeah, I'm looking to try to get it to a full position. And for me, like I said, that would be ideally somewhere around 3%.
Yep. Awesome. Thank you for elaborating on that. So I know that you wanted to pull up some of our weekly reports that we do for Limelight Alpha. So however you want to approach that, go right ahead.
All right, let's go ahead and share my screen. And again, listeners, we do post these on YouTube, so you can check when we're putting up charts or when we're looking at different things if you want to follow along. On Seeking Alpha, Limelight Alpha has a service called Top Stocks for Tomorrow. We produce reports that we put up there regularly throughout the course of the week as idea generation. Joe, give me a thumbs up if you can see the screen.
Yep, all good.
Yep, perfect. All right, so you can see where we put up our podcasts. You can see how we do best and worst large cap, best and worst mid cap, best and worst small cap, best dividend stocks, best stocks by sector. And if you just click on that best large cap stocks, we can see here we give a little introduction. And what we do is we walk you through the highest scoring sectors. One of the things that was funny, Joe, I was just recently rereading William O'Neill's book on stocks in the market. And one of the things that I thought was really fascinating is that he argues that 35 to 50% of a stock price action is going to be dictated by the group. And he defines the group as either the macro sector or on a more micro, the subgroup or the industry. So one of the reasons that we do this research this way is so that our readers identify which baskets have tailwinds, which ones have tailwinds, which ones have headwinds. And I think that can be very, very useful. As you can see in the large cap, industrials, basic, and consumer, followed by technology, financial service, utilities, and healthcare. And you've got this bunching in the middle here. Oftentimes when you get bunching like this, it means that the market is about ready to digest. You could get some new leadership emerging. So it'll be very interesting to see how that plays out. I did look this morning. Technology has slid further down the ranking. It's now lightly red. That would just tell me that I need to be very selective on my stocks. It's got to be a high scoring stock. It's got to be a high scoring industry. So for example, semiconductors. So I would be going long semiconductors, and I would be trimming back my exposure maybe to application software and infrastructure software. And this is just something that I would have been doing, and I have been doing over the course of the last 4 weeks as the research has been signaling that to us. Financials actually strengthened a little bit, and our report that's coming out this afternoon will show that. But industrials, basics, consumer all still remain very strong. And that's kind of like the hunting ground that I would stay focused on. Then you can see we give you just across all sectors from high scoring to low scoring. And we show the 4-week moving average of scores so that people can get a feel directionally of whether the score is getting better or worse. And we give you the best and the worst scoring. And then if you go down a little further, you'll see our industry ranking. And you can see here why I'm talking about semiconductors, right? And we've talked about this in the show, right, Joe? I think we had 3 or 4 different times we've called out semiconductors over the prior 9 episodes that we've done.
Absolutely, yeah. We've picked out, or you've helped pick out some really strong semiconductor stocks, and then over the past probably 3 weeks now, one by one, they start to break out.
Yeah, it's been a really good run for some of these stocks. And I think that there's still some more left in the tank. Usually the seasonal tailwinds for semiconductors stretches into early in the following year. So I think that there's more room to go for these stocks.
Yep.
And I would just stay focused on the highest scoring of the bunch. And you can see a couple of them. NVIDIA, for example, had really good numbers. The stock traded down a little bit yesterday. I hasn't moved as much as the others because there's some overhang associated with its planned acquisition of ARM Holdings and that uncertainty. So I think that that's when you can buy. Monolithic Power is when you can buy. Microchip Technology I saw was up it's up 4.6% already today. So having a nice day today. I think that's another one that can be bought. And then of course in the equipment plays, Lam Research, KLA 10 Core are 2 that I really like a lot in that basket. So semis is still strong, scores pretty strong for us. And then you can see some of the industrial groups, et cetera. And then we give you stock ideas for each of those strong industries. And we do this for large cap, mid cap, and small cap. And again, just to go down to the technology in the bottom here, electronic components, semi-specialized, semi-equipment materials, those are all really high. And then if you go to the lower scoring ones, application software is still positive. It's green, right? It's a buy, but much less lower score than say some of these higher scoring baskets.
Yep. Perfect. Awesome. All right. Well, with that, is there anything else that you wanted to bring up before we wrap up for this week? And I suppose next week as well, since Thanksgiving falls next Thursday.
Yeah, with Thanksgiving, I think we probably give ourselves a break. Let's do some individual stocks. I'll go back and pull up my charts because I do like to do this every week. I like to go through and see what kind of stocks are showing up in the research and high scoring that might be worth looking at. So again, if you're listening on the podcast on Spotify or Apple iTunes or whatever, we do put these on YouTube if you want to see the charts. If you don't have your own charting service, you can always pull it up as once you get home, you can write down some of these symbols. But one of the things we had talked about a couple of weeks ago, we kind of hinted about it earlier on today's show, Joe, was some of the strength in the autos. Tenneco is another auto stock that had caught my eye as I was going through it. High scoring in our research, looking to go and bounce back from a very weak earnings in 2020, caused obviously by COVID restrictions impact on the auto industry, and bouncing back significantly in earnings in 2021, or at least expected. And even you're seeing the sequential 41% drop year over year in Q2, becoming only a negative 1% drop in Q3. And one of the things that I like to look for is, money flow, Joe. So, I mean, you see these buy days and the rising volume and more buy days dwarfing sell days. That's a good sign to me. And then if I look out further on a weekly chart, I can see that the stock has plenty of running room if it were to break out and go higher. And again, a pretty tremendous yield on this stock as well.
Yep.
So I think that this is a stock that I would look at in that basket. I would also look at Cooper Tires. There's just some seasonality associated with tire companies, winter weather, et cetera.
Snow tires, exactly.
Yeah. I mean, this is a company that's also doing well, though, with there's a lot of demand right now for used cars. And oftentimes what will happen is people will trade in their vehicle with the older tires. And then when, whoever's selling the car will then put new tires on it for the next owner, so it'll pass inspection, whatever. And I think that that's also a tailwind. You can see the expected earnings per share growth in 2020, 55%, 2021, 25%. And you've got a company that grew 9% year over year in the third quarter, despite, COVID headwinds. So that's another one in that area I would look at. I also wanted to give a shout out to the footwear retailers. Foot Locker is one that is catching my eye. Significant earnings expansion expected, bounce back to 2020 levels, the 2022 timeframe. So going down to 188 and then rising back up to 403 on the fiscal year. You've got 9% year over year revenue growth for the company. And again, I really like the fact that there really isn't a whole lot of energy on those sell days. I don't think anybody's really eager to get out of Foot Locker. And the same holds true for Shoe Carnival. SCVL is the symbol there. And you can see again, Joe, you have this, these buy day spikes on higher volume, and on the down days there's really not that much institutional interest in unwinding the stock. And again, you're talking about going back 2020, 279 in earnings, falling to 93 cents fiscal 21, and then bouncing all the way back to 346 in the following year. So it's that kind of that story we've talked about in the past on the show, Joe, where you're actually you have to remember that yes, stocks follow earnings over time. And people had asked us previously, well, yeah, but earnings were really bad because of Q2 and GDP falling 30%. But again, markets are forward looking. So they're going to look at that forward earnings projection and then compare it to where we are today. So they're going to say, okay, well, is it going to be higher than it is today, right? So that's really what you need to be focusing on when it comes to those stocks. Healthcare doesn't screen very well in the research right now for us, but we did give a shout out earlier in the show to ABBV as a high scoring stock, and you kind of see how that chart looks. Double-digit earnings per share growth expected in 20 and 21. Very strong revenue growth for the company still. And then Pfizer, you've got earnings deceleration, which I don't like, and revenue deceleration, which I don't really like. But you do have an interesting technical entry point here down near the 200-day moving average. And we talked about that emergency use authorization for their COVID vaccine. They do have a contract already in the US for about, it's $1.95 billion contract with for 100 million doses, with an option to expand that to 500 million doses.
Yeah,
So
I would not be surprised if that stock jumps in the next few trading days, because I've heard that they're trying to get that authorization as soon as today. So we're recording this on Friday. So I'd be pretty surprised if there wasn't a bump in that in the next, few days.
Yeah, and Joe, I mean, I'm at heart, I'm concerned about the story of the company and what could drive it higher or lower. But for 25 years in the business, I have used charts to help me figure out entry and exit points and just to sort of see what the sentiment is for the market. Excuse me. And one of the things that I do like about this kind of a setup is that you had this prior peak, close to $42 per share. It's retreated now to that 200-day moving average. And to me, that gives me a little bit of confidence that, okay, I can define my risk. So if I'm a shorter term or a position trader and I'm saying, well, I don't know if I want to have Pfizer for the rest of my life, but maybe I want to have it for 6 months, 18 months, or maybe I just want to sort of trade around the edges. I can say to myself, yeah, I'll take it here, but then if I'm wrong, I'll get out below 35 or 34.60. This line in the Daily Graphs is already charted out for me.
Yep.
I'll just walk away and focus on other ideas. So you can kind of see how you can control your downside risk, which is obviously an important thing to keep in mind for investors. And then, we talked about the semiconductor charts or stocks, and some charts there that still look good to me. I mean, we saw Cree breaking out on exceptionally high volume on its earnings report. You can see it busting out right here and the volume surging on it. Power switches and RF stuff, that's big with 5G. That's big with all the consoles and the electrification basically of everything. So I think that there could be still some running room on that. I would look to try and get an ideal entry of somewhere around 78 to 79. It's currently at 83. So maybe just have that on your watch list. Also in technology, we mentioned Ring Central earlier in the show. Let's pull up that chart, RNG. RNG, again, that's kind of like an enterprise competitor to Zoom in a way, because they do allow video conferencing for their enterprise communications platform. And that sales, you can see, up 30% year over year in the third quarter, 29% in the quarter before that, 33% year over year in the quarter before that, 34% in the quarter before that. So I really like that consistency and growth. And then if you look at the earnings, up 17% year over year in 2020, up 21% in 2021. So there's a smattering, Joe, of different stocks that caught my eye as I was going through the research today.
Yeah, plenty of great ideas out there for sure. We're coming into kind of the height of holiday seasonality too, and so there are dozens more great options out there that
you saw that Target report, right, Joe?
Oh yeah, I was thrilled about that one.
I couldn't believe it. We saw that year-over-year comp sales for Target up over 20%. I'm like, how does that happen with a company that big, a retailer that big? Those numbers are downright gaudy numbers.
Yep, proud shareholder right here.
Oh, great, congratulations. Me too.
Thank you. All right. So with that, do you have any parting words for us before we part ways with our viewers for the next couple weeks?
Yeah, I just want to wish everybody a happy Thanksgiving. I know it's going to be an odd year for everybody, but we need to keep our priorities straight and remember that the goal here is to not just have one Thanksgiving, but to have happy Thanksgivings for decades.
Absolutely.
So everybody stay healthy, stay safe, and we look forward to getting back with you, soon.
That's right. We'll see you in a couple of weeks. Have a happy holiday, everybody.